Hey everyone, welcome back to Corporate Decoder, the place where we decode what companies are really saying in their official filings, because let me tell you, sometimes it feels like they're speaking in ancient hieroglyphics. Today we're diving into the latest annual report from New Century Logistics BVI Limited, ticker symbol NSHU. So, imagine a logistics company that relies heavily on moving goods by air and sea. What happens when their main customers hit a rough patch and orders start to drop? Well, this report spills all the tea, showing us a really interesting financial pivot and some significant risks they're trying to navigate. Let's get straight into what is happening with New Century Logistics BVI Limited, or NSU as you might see it on the stock market. They are a holding company that actually does its business through subsidiaries, mostly in Hong Kong. They handle freight forwarding, which is basically like being the organized middleman for shipping everything from small packages to big cargo. Now, the financials are where things get really interesting. For the year ending the 30th of September 2025, NSU saw its total revenue drop significantly by about 15.5% down to $44.08 million US dollars. This is a pretty big dip from $52.18 million US dollars the previous year. The report says this was mainly because some big customers were having a tough time and just did not order as much. This means about $1 in $6 of their revenue disappeared in that year. Looking closer, their air freight business, which is their biggest moneymaker, took a hit. Revenue there fell by over 12%. Think about it like this: if air cargo is usually their bread and butter, and that stops selling as well, it really impacts the whole company. Even their other services like warehousing and palletization saw a massive drop of over 51%. That is a huge cut. This suggests that maybe the clients who use their main shipping services also cut back on the extra services they offered. It is like if your favorite restaurant loses customers, they might also sell fewer desserts. This revenue drop really ate into their profits. Their gross profit, which is what is left after paying for the direct costs of providing the service, went down by a staggering 96%. They went from making $4.24 million US dollars in gross profit to just $162,000 US dollars. That is a massive change, their gross profit margin, which shows how much profit they make on each dollar of sales after direct costs, also fell from over 8% to less than 1%. This is a huge warning sign about their ability to make money on the services they sell, especially when costs remain high. And then to raise this really eye-catching expense, share-based compensation. In 2025, they recorded $6.35 million US dollars in these types of expenses, while the year before it was zero. This usually means they gave out stock options or shares to employees or consultants as a way to pay them, or to keep them around. While this can be good for motivating people, it also shows up as a big expense that directly hurt their bottom line. Putting it all together, North Carolina U went from making a small profit of about $220,000 US dollars in 2024 to a significant net loss of almost $10.7 million US dollars in 2025. That is a massive swing from making a little money to losing a lot of money in just 1 year. Let's check on how they're collecting money from their customers. Their accounts receivable, meaning the money customers owe them, fell from about $13.2 million US dollars to $11.7 million US dollars. This could be good if it means they collected more money, but the report mentions they extended payment periods for older customers. Sometimes this is done to keep good relationships, but it can also mean they are having trouble collecting payments, which ties up their cash. Looking at their liabilities, a big change is that their loan payable to a related party, Asia International Securities Exchange Company Limited, went from about $2.4 million US dollars down to zero. This means they paid off a significant loan, likely from a shareholder or investor. This is positive as it reduces their debt. Their cash situation is a bit mixed. While their total cash and cash equivalents increased slightly to about $996,000 US dollars, they now have restricted cash of over $300,000 US dollars, which means that money is set aside and cannot be easily used. This might be for collateral on loans as hinted in the notes. They mentioned they had no significant financial or capital commitments other than their lease and debt obligations, and importantly, management believes there were no pending or threatened legal issues. This is a good sign, meaning no big surprise lawsuits are looming to further damage the company. Remember that big share-based compensation expense from earlier. It points to their new 2025 equity incentive plan. They granted a large number of shares, and this upfront cost definitely impacted their 2025 results. It's a big bet on future growth potentially paying off, but it surely hit them hard this year. Now, let's talk about the dangers they're up against. The risk factors section is always a good place to see what keeps management up at night. They are in a very competitive industry, which is pretty standard, but they also mention that their results can swing wildly due to changes in demand and supply for cargo space. If they book too much space and cannot fill it, they still have to pay. If they do not book enough and demand surges, they could lose customers. This is a constant balancing act. And a big point is that their main shareholders have a lot of power. With Qingshon Yingen owning over 32% of the shares, he can really influence major decisions, which could be good or bad depending on your perspective as an investor. They also warn about potential extreme stock price volatility, low trading volumes, and wide price differences between buying and selling. This means it could be hard to sell your shares when you want to, and the price could bounce around a lot for reasons unrelated to how the company is actually doing. Now, putting on my analyst hat, North Carolina EU's recent filing paints a picture of a company struggling with declining demand in its core business. The huge drop in gross profit and the shift to a net loss are serious concerns. While the payoff from their new employee incentive plan might help later, it is a costly investment right now. The company's heavy reliance on a few big customers is a major risk, as seen by the revenue drop. They really need to find ways to diversify their customer base or bring in new revenue streams quickly. The fact that they are a holding company and rely on their subsidiaries for cash also means any issues in Hong Kong's business environment could directly affect them. In my opinion, North Carolina EU is facing a challenging period. They have the strengths of an experienced team and a working business model. But the market headwinds and the big hit to their profitability raise questions about their immediate future. They need to show they can manage costs effectively and find new growth avenues to overcome this tough patch. That is our look at New Century Logistics, BVI Limited's latest report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out our Discord community linked in the description below for more insights and discussions. Thanks for watching, see you next time.